Hi, I'm Joel Shapiro. I teach financial statement analysis at the Goodman Institute of Investment Management in the John Molson School of Business at Concordia University in Montreal. I also teach accounting to undergraduates at Ryerson University in Toronto, where I live. This session, we're going to talk about three specific topics which appear on the liability side of the balance sheet, usually in the long-term liability section. These would be deferred taxes, leases, and long-term debt. We're going to talk about deferred taxes first. And the whole idea of deferred taxes is the idea that accounting income, which is what you see on a company's financial statements, and their taxable income, which is what you see on their tax return and on which the income tax that is payable is actually based, are almost never the same number. This is because the rules are different. The items that are counted as revenue on the income statement aren't necessarily revenue for tax purposes. Sometimes they're not revenue at all. Sometimes they're just revenue earlier or later. Same thing with expenses. Many of the expenses on the income statement are not expenses for tax purposes or are counted in a different period. In addition, there could be items allowed or taxable on the tax return which have no counterpart in the financial statements. So you have differences between accounting income and taxable income. These differences may be permanent differences or temporary or timing differences. And it's important to be able to understand both of them. It's also important to be able to tell which kind of difference one is, because they are accounted for differently when you reconcile between accounting income and taxable income. One small point about terminology before we continue. Deferred taxes is American terminology, and in Canada they are referred to as future taxes. But it amounts to the same thing. The accounting is done identically. You will just notice different terminology on financial statements. The difference between permanent and temporary or timing differences is whether or not the item will appear on the books but not the tax return ever, or vice versa, or whether they do appear on both but only in different timing periods. Some permanent differences first. Permanent differences are either of two types. They are revenues which are never taxable, or expenses which are never allowable. Examples of the first one: a revenue which is never taxable. In the United States, that would be income on many kinds of municipal bonds. In Canada, an example of a revenue which is not taxable would be dividend income received by a corporation from another corporation. The Canadian tax system avoids double taxation of that sort of income. Expenses which are never allowable often include things like fines. I've never been quite sure why they call them fines. Nobody I ever know who ever had one said it was fine, but anyway, that's what they call them. Fines, penalties. Life insurance premiums, again, are things which are never allowable. Certain kinds of travel, entertainment, and advertising expenses might also be in this category. It's not a matter of them being taxable or allowable in a different period. It's the idea that they are on the income statement as revenue or expenses, but they will never appear in the tax returns. Timing differences, however, are different entirely. Some examples of those follow. Temporary differences, also called timing differences, are revenues which are taxable or expenses which are allowable but are recorded in different periods on the tax returns and in the books. The one thing to remember is that most tax codes, in whatever country you might happen to be in, are based on the cash basis of accounting to a large extent. Many things like reserves for bad debts or obsolescence, prepaid expenses, deferred revenue, different kinds of accruals like that are not allowed on the tax return until the cash is actually received or paid. We don't do that in our books. We use the accrual method of accounting and count the transaction regardless of whether the cash is received in advance or paid in advance, or received later or paid later. So we'd end up with timing differences between the tax returns and the financial statements. A big one often relates to a non-cash expense which is depreciation and amortization. Most tax codes allow a company to amortize its capital assets on a completely different basis than that which is permitted by generally accepted accounting principles. This makes sense from the government's point of view. Most governments would encourage companies to invest in their businesses, to buy particular kinds of assets. In some cases, the government might wish to encourage a particular industry or perhaps a particular activity, perhaps the purchase of pollution control equipment, for example, and therefore might allow a company to write off an asset of that nature in a very, very short period of time. Generally accepted accounting principles requires you to choose a reasonable useful life for an asset. A new smokestack scrubber or a settlement pond, something for pollution control like that, might last 20 years and be depreciated on your books for that period of time. Just because the government allows you to write it off immediately or over 2 or 3 years doesn't mean that you can do that for book purposes. And so we have a difference there, which can be a fairly major difference until such time as that asset is fully amortized under both systems or perhaps sold. So, to summarize, temporary differences, revenues which are taxable, expenses which are allowable, they do occur in both the tax and books, however, in a different period for tax and book purposes. Either can come first. It doesn't matter if the revenues are taxable first and on the books later, or the other way around. Same thing with the expenses. As long as they're in a different period, they are considered temporary or timing differences. The key to understanding temporary differences is understanding that they do reverse eventually. Some are short-term, some are long-term, but they do reverse. To do the calculations of future tax, what you have to do is a calculation of what the tax would be if there were no temporary differences, and what there would be, what taxes are with them, and understand whether the tax is paid, whether there's extra tax paid now, which means that there'll be a tax saving later on, or whether there is a tax saving now, which means more tax will be paid later on. So obviously there's two different possibilities, and you'll have to understand how both of them work. Here's the first one. If current tax payable, that means this year, is lower than it would otherwise have been, then you have a deferred tax liability. You're saving on your taxes now. It will catch up to you later when the timing differences reverse. Most timing differences, in fact, work this way, to the taxpayer's short-term advantage. So you end up with deferred or future tax liabilities, which, when the timing differences reverse, have to be paid. A summary of how that works for tax purposes and book purposes. In the case of revenue, okay, if revenue, in the case of a deferred tax liability, this would be a result of revenue being recorded later for tax purposes and sooner for book purposes. Revenue in your financial statement today which isn't taxed yet, usually because it hasn't been received. With expenses, it's the other way around. Sorry for the mess. Even I get it wrong sometimes. I have to think about it, and so will you until you get used to it. Expenses which are allowable for tax purposes sooner rather than later will result in lower taxable income today. And again, that will catch up to you eventually and require higher taxes later on. The opposite is true, of course, the exact opposite if everything works in the other direction. And this is the case if it works in the other direction. If current tax payable is higher than it would otherwise be, then you have a deferred tax asset. This can be considered almost like a receivable from the government. It's a benefit that you're going to get by virtue of having paid more tax today than you would otherwise have done had there not been any of these differences. Presumably, these deferred tax assets will reverse, and you will receive the benefit of it later with tax savings in the future. Here's the chart. For tax purposes, revenue which is recorded sooner rather than later will result in taxes being paid now. Later on, you'll save that by virtue of having essentially prepaid your taxes. And with expenses, It's the other way around.